I'm joined right now by Rahul Singh. He is one of the most respected people in the stock markets in India. He's managing partner at Ampersand Investment Advisors. Thank you so much, Mr. Singh, for taking out time for us. Let me start off with a broader market question right now. And I know as a long-term investor, it probably doesn't affect you. But if our viewers are watching, do you think that this is the time they can, if they've not invested, they've been watching on the sideline, should they start investing now, or should they wait and see that you expect some sort of a correction to come and that would be the right time to get in?
Hi. So I think the risks of downside are very much there. I think if someone who's not invested can put in 25% of the money which he wants to invest in at this point of time at the current levels in the markets, and especially given the mid caps the way they are still holding on, and then wait for a slightly longer time correction, or probably a deeper correction. Our view is that we will probably get a longer time correction rather than a deeper price correction. But having said that, I think for new investors, it makes sense to probably deploy 1/4 of what they want to deploy at the end of this corrective phase.
Or end of the corrective phase, you say. So we have seen some time consolidation, time correction, consolidation taking place for almost 2 months or more.
Yeah, so I think what I meant was that this corrective phase will probably last some more time, because if you look at the results and what the companies are saying, most of the companies, even in the consumer discretionary side, in their results commentary, have said that they expect the second half to be better. And when they say second half, November, December becomes extremely critical for some of those macro data points and recovery to start showing through, whether it's because of monsoons or pay commission or lower rates. So we have had a nice turn in the macro tidings based on these three factors, but that has not really resulted in exact pickup in the numbers in terms of the consumer demand or in terms of the investment demand. Most of it is ahead of us. Now, when we say most of it is ahead of us, are there risks to it? I think there are risks that the expectation which is there, especially in mid caps, given the valuations where they are sitting on, the expectations of a slight disappointment is always there, and that slight disappointment could turn into either a longer time correction or a deep price correction. So we have seen that in this results season, for example, so far, that good results have been treated with enthusiasm, but not so much enthusiasm, whereas the bad results obviously have got punished. So obviously the market is running out of steam a little bit, and it's showing up in the last 2 months. It could continue to show up for the next couple of months as well.
In terms of the markets themselves, people who are investing, trading on a regular basis, circulating their money from one part to the other, how important right now is it for them to look at global liquidity? Are they looking at earnings alone right now in India, or are they continuing to look at global liquidity?
So we have to have an eye on the global liquidity. But I'll step back a little bit and talk about mid caps here, especially because a large part of the mid cap, small cap, micro cap rally has not really been driven by global liquidity. Obviously, the global liquidity is helping the large caps, the index stocks, and so on. But the mid cap and the small cap rally has been driven completely by the domestic money flows, whether it's in the mutual funds, the mid cap funds, or in PMSs and so on. So therefore, that leg of liquidity is still very strong. I don't see it going back or kind of turning back, because if you look at the other investment options, the rates are coming down. Gold is no longer an investment which people now look at. Real estate is obviously not going anywhere. So equities is in a sweet spot in that sense from a domestic flow perspective. But obviously, it cannot continue endlessly. There will be sanity checks in between whenever valuation gets ahead of fundamentals, and we are at a point where it seems like that the risks to downside are slightly more than the risks to the upside, given that the valuations have gone up and the data has still not come in.
So when I look at Ampersand Investment Advisors, what kind of people, what kind of level of investors do you advise, do you work with?
So we are basically a SEBI registered investment advisor, and we are advising family offices and high net worth individuals on their equity portfolios, direct equity portfolios.
Does that have a minimum SEBI defined minimum amount there? Is it 25 lakhs that someone has to have to be able to get your advice?
No, actually the investment advisory rule or the license is pretty flexible on that. So we have an investment advisory license and not a PMS license. So we are advisors. We don't invest on their behalf, and we get fees and for our advice. So there is no minimum criteria which SEBI prescribes. But by the very definition, since we are advising HNIs and family offices, our investors or our clients tend to be larger investors than the amount you mentioned.
So does it become more a capital protection thing when you advise them? With people with a lot of money, they're not really looking only to increase their wealth, they also need to protect the capital that they have. So does that change the nature of advice that you would give to a person, let's say, who has just 1 lakh rupees to invest versus the kind of HNI or family office?
No, not really. I mean, the direct equity portfolio for most of these family offices is only part of their wealth. So it is not that 100% of their wealth is in equity, so we need to have a capital protection strategy in place. So they obviously allocate a certain part of their total wealth into direct equities, and to that extent we have a pure growth approach. We don't have a value approach per se. And our investment philosophy is to identify ideas and sectors where where growth is going to be likely surprising the market expectations, and which is where, if you look at our themes which we have played on over the last 9 to 12 months, we started with specialty chemicals, moved on to cement and NBFCs. We still like cement. Now we also think the construction space is leading to some very interesting opportunities in the construction equipment space. So we are now focusing on that segment where I think the valuations have still not run up, and there are opportunities for a pickup in demand.
Do your disclosure norms allow you to talk about specific stocks, Mr. Singh?
Yes, with the disclosure that most of the stocks which we talk about would, our clients would have interest in those stocks.
Okay, then let me start off with that last point that you made about construction and construction equipment. I've been asking this question to many people, and most people have not really focused too much on this. And I'm really keen to get your views and pick your brains on that. If you could just give us, what are the ideas there? What kind of stocks are you looking at?
So if you look at the public spending capex, I mean the private capex is not picking up. Everyone knows that. It could take 6 to 12 months. But the public capex or the infra spending from the government and government agencies is in full swing. And we have seen the order books swelling in the E&C companies. All the E&C companies almost which we have looked at are sitting on order book to sales ratio which are at a 3 to 4 year high. That means that the execution of these orders are beginning to start now. We will see the numbers, the top line of these ENC companies going up in the next 12 to 18 months. But if you look at what kind of demand it is generating for equipments, which is basically all the kind of construction equipment which goes into, say, roads or railways, and movement of goods in general, there is a demand which is, for example, the construction equipment segment as a whole grew 49% in April to August this year, as per the industry data. So what it is resulting in is to lead to a demand increase for the companies which are suppliers to these construction equipment. So we are talking about companies like Kirloskar Oil Engines, Cummins, who supply engines to the industries which supply construction equipment. And these are sectors and stocks which are good quality managements, very capable companies, but obviously not in focus over the last 2 or 3 years. So we think there is an opportunity there for a sustained 2 to 3 year kind of a demand increase. It could take another 3 months, 6 months for it to start showing up in numbers in some cases. But I think there is an opportunity here in this space to capitalize on this capex boom which is ahead of us, especially in the public spending side.
So you're actually choosing the suppliers rather than the construction companies themselves?
At this stage, yes, because suppliers, the ENC companies still have a lot of balance sheet issues. I know some of them are getting resolved with the new cabinet decision on releasing some payments which are under arbitration and so on. But there are still issues there. We will obviously look at those sectors more closely, maybe 3 to 6 months down the line. But there are good quality companies available there as well. So, for example, one of the companies which we like in the road construction space is KNR. It is sitting on order book to sales ratio of 5 times. Balance sheet is pretty stable and clean. We think the execution is going to surprise on the upside in KNR compared to what the market is expecting. So that's one name which really stands out among the names which we have looked in the ENC space.
There are a few others like PNC, then Ashoka Buildcon. Have you looked at them, and do you find them worth buying, or you think that they're kind of expensive at the moment?
No, I think what we have to look at, you obviously can look at a basket of these, but if I were to pick one name, that will be KNR. What also happens especially in road construction space and a lot of these ENC space, is that the mid-sized players tend to focus on certain geographies. So KNR is mostly south-based, PNC is mostly north-based, both very similar, but very little to differentiate them. But what I would like to tell investors is basically that you have to focus on one company in that segment and the best company in that segment and go ahead with it, which is why we focus on KNR more than others.
All right. Before I move on to some other sectors, just I need a clarification. When you say that your investment philosophy is actually more on growth and you don't do value-based valuation analysis or whatever, even if you do, it's not a value-driven model. Is there also an element of momentum here? Is it a long-term growth that you're looking at, or do you play the momentum and then get out?
No, I think it's growth relative to expectations. I mean, it's very important to identify growth ahead of others. And when I say others, it has to be at reasonable valuations. So some of the names which I mentioned, for example, Cement or NBFCs, we were slightly ahead of the curve in terms of identifying these opportunities. Similarly, in the construction and construction equipment space, I think it's still largely an unloved sector, and it's an out of sight, out of mind sector. So we would obviously look at sectors which are not, in fact, contrary to what you said. We would like to look at sectors and stocks which are not really momentum plays. It works the other way around because what we are trying to identify is growth at reasonable valuations and not at any valuation.
So, let me rephrase that question actually. What I meant is that once it's done its run, do you get out or do you hold on to these companies? Again, as you said, they're out of mind, but once the market starts looking at them and they move into that momentum space, people start buying, funds start covering, do you get out? And that specifically question would apply to NBFCs, for instance.
Yeah, I mean, that depends really on how soon and how unjustified the valuation becomes. It's very difficult to answer that question with a blanket yes or no, because in some cases we have remained in most of the cases we have remained invested. For example, in cement we remain invested, and we've even added some we've even asked our clients to add positions on
the ones that you are invested in the cement space?
NBFCs. So I think our clients, I mean, we basically advising still the investors to be, our clients to be invested in Shri Cement, Dalmia, and one of the north-based producers, which is JK Lakshmi. So these are the three stocks we prefer, and we are still advising to remain invested in the cement sector. So NBFCs is a slightly different ball game because there the valuations run up has been very, very sharp and in some cases unjustified. So we are mostly in housing finance companies at this point of time for our clients, not really in the other segments of the NBFC space.
Which ones have you taken? Have you advised your clients to take profit off the table from, and which ones are you advising them to stay on in?
Well, I think the normal finance companies, whether it was ABNL or whether it was the gold finance companies, I think the valuation run up is now quite up to the level where most of the positives are priced in. So we have advised our clients to take money off the table there.
And the ones that you're still telling them to get into or hold on to?
That's only the housing finance company that I mentioned, because if you look at the rate declines which have happened and which are ahead of us, for housing finance companies there is an opportunity to still improve their NIMs going forward over the next 2 to 3 quarters, and the valuation in some cases is still reasonable. So we particularly like LIC Housing Finance, where we think the valuation relative to the ROE profile and the business profile is still reasonable. So there could be some amount of re-rating which can happen in LIC Housing Finance.
Okay, and, there's another out-of-mind sector, at least it comes up once in a while and then people take money off the table, and that's real estate. Do you think that it is something that people can start buying, or is it still far away from any recovery?
Well, it's interesting because the pace of new launches have come down across all the cities, and the absorption rates have not come down as much, so they are still holding on. So we are getting to a point where this sector could become interesting. But to be very frank, it's going to be a regional approach, so we'll have to look at market by market and look at markets which are probably where the absorption rates are much higher, like in the south, as compared to say NCR, where the absorption rates are still very, very slow. So I think it's coming to a point where the sector could become interesting, but it could still be a long wait. Even if you get in now, it could still be a long wait before the inventory starts to get cleared off. So we would rather stay on the sidelines for some more time, for maybe a quarter or two before we can take a firm view on the sector.
one final question. Is there any specific sector that you're now studying, looking at? You've not had any specific choices, but you've just started looking at it?
Well, we've had a look at banks a number of times in the last 1.5 years without any conclusion. So we have asked all our investors to stay out of that sector for the last 12 to 18 months. So that's one sector which which obviously pops up on every valuation screen, especially PSU banks. So I think the whether you call it opportunity or valuation or a mix thereof, there could be an opportunity like real estate in the next 1 or 2 quarters to have a look at that sector and make some bets on that sector, but not again it's at a point of time where the conviction levels are still not as high as they should be for sectors like that to be picked up in the portfolio.
All right, Rahul Singh, thank you so much for taking out time for us, and I wish you a happy Diwali. Thanks a lot.